If you're new to the stock market or have been trading for a long, you'll probably come across the term ETF. ETFs are similar to stock in that they are a security with fluctuating value. However, they operate in a very different way than traditional equities in terms of how they generate value. Welcome to the Investing Wise Academy, a channel where aspiring millionaires and billionaires can learn how to invest wisely. In this video, we're going to talk about exchange-traded funds or ETFs. If you're new to our channel, please subscribe to see more videos like this. Let's get started. ETFs are a type of investment fund composed of a number of different types of securities. Typically, each stock has its own name. An ETF keeps track of the price change of a variety of companies, stocks in specific industries such as technology, food and beverage, mining, etc. ETFs trades like normal stocks in open markets, but they give investors a great deal of security and less volatility than if they were to buy individual equities. ETFs are quite similar to mutual funds, with the exception that ETFs are traded on exchanges where our mutual funds are not. As a safe investment and strategy to spread your risk, ETFs are the answer. Among the most popular ETFs are the SPY, which replicates the S&P 500 in single security or unit, and the Dow Jones Industrial Average ETF. It's important to remember that these ETFs are just a group of companies that are in these indexes. They track the price of changes of each index of companies, but they are not the indexes themselves. They offer safety. In short, ETFs are a single security that is made up of a group of stocks or other securities. Their prices go up and down just like stocks, but they don't change as much as stocks do over a given period of time. There is an exchange-traded fund for every conceivable asset class, from crude oil to power, from food to water. ETFs make it possible to gain exposure to a multitude of different firms, such as Amazon, Tesla, Google, and others, without having to fork over the significant sum of money required to personally own the equities of each of those companies. ETFs are likely the greatest option to pursue if you want to take a more conservative approach to your investment plan over the long run. It's possible that holding big shares of particular firm's stock will result in higher return, but the opposite is also true. It is possible to wind up losing all of your investment in a company, but this is much less likely to happen with an exchange-traded fund. The danger is not very high. Let's take a look at the various exchange-traded funds now that we've covered the fundamentals of what exchange-traded funds are and what they do. Because ETFs are available in such a wide variety of forms and formats, it is quite probable that you will be able to locate an ETF that corresponds to the specific type of investment that you have in mind. There are several types of ETFs, including bond ETFs, which are comprised of government and corporate bonds, industry ETFs, which track industries such as technology, banking, or oil and gas, commodity ETFs, which track the prices of crude oil, gold, silver, and other valuable resources, currency ETFs, which track the changes in the value of various currencies such as the euro or the US dollar, and inverse ETFs, which is increased in value when the value of a group of these exchange-traded funds essentially gamble against the underlying stock or short it, and as a result, their value moves in the opposite direction of that the stock. When searching the open market for exchange-traded funds, you should be aware that a significant number of products listed there are not genuine ETFs, but rather exchange-traded fund notes, or ETN. ETNs are simply securities issued by banks that are guaranteed to track the underlying index. In contrast, exchange-traded funds actually hold the stock or security that is being tracked by the ETN. ETNs do not include actual ownership of the underlying securities. When it comes down to it, exchange-traded notes and exchange-traded funds serve the same purpose for investors. However, when you purchase an ETN, you should be aware that you're actually purchasing a guarantee from a bank and not the actual securities that it follows. ETFs gives investors the ability to purchase a broader range of firms at a cheaper overall cost. A hypothetical purchase of a technology exchange-traded fund would cost you $50. On the other hand, if you were to buy all of the equities that make up the underlying index separately, you might require something like $10,000. You end up getting the same return rate in the end, but with a far smaller initial investment to obtain the exposure to those companies. These expense ratios of the majority of ETFs are quite modest. In contrast to individual equities, exchange-traded funds are more akin to funds and portfolios, such as they require some level of supervision from bankers. This indicates that some exchange-traded funds may have ownership fees, but in general, these fees are typically quite minimal. Because they don't have to be actively managed, ETFs that mirror indexes will have relatively minimal expenses. However, if an ETF follows something like crude oil, it may have a high cost because of the underlying investment. In this case, crude oil requires a lot of attention to be taken care of. You can get into an entire industry inexpensively with ETFs. You can get into firms' and vast stocks collection with reduced upfront expenses, and you can improve risk management to your portfolio because diversification is built in with ETFs. If you overinvest in a single industry, you may be limiting your market exposure with an ETF because of the higher fees and lower liquidity. There are fewer persons interested in purchasing them. ETFs are a great first step into investing for any beginner and can be a great long-term way to build wealth. That's all for today. What are your thoughts on ETFs? Join the conversation in the comment section below. Please click the like and subscribe button if you enjoyed the video. We'll see you in the next one.